Thursday morning. Welcome to Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. Lots to get to today, so little time, so here we go. With President Trump dialing back his rhetoric on Greenland, a touch at Davos on yesterday, I should say, and saying there is framework for a deal to obtain the country or the piece of ice, as Prez coined it frequently. The dip buyers have returned to Wall Street. Where are they hunting, you ask? In one of their favorite hunting grounds, Momo stocks, or more formally known as momentum stocks. Figured I'd spell it out there for you new investors out there. Shares of chip player AMD are on the move today following a 7% surge on Tuesday. Good week indeed for AMD CEO Lisa Su. Go figure on this. Intel is also rocking after a surprise 11% move yesterday. The company will report earnings after the close today, having one of the hottest stocks in the entire market, up 48%. It pays to have the backing of Uncle Sam and NVIDIA. Mass layoffs help too. One former high-flying stock not basking in the love of the dip buyers, Netflix. The stock is now at a fresh 52-week low and is down 22% since the December 5th offer to buy Warner Brothers Discovery for $72 billion. I didn't like the company's guidance earlier this week, and I assure you I am not alone in that viewpoint. Bottom line here, can this momentum in markets continue? Can we get so much momentum going again that the stock market damn near doubles this year, as President Trump suggested could happen at Davos this year? What do you expect the president was going to come out and say the stock market was going to crash? Of course not. On the opening bid roundtable, I feel bad for them because I'm going to ask them about the stock market double thing. Ben Emons, FedWatch Advisors Chief Investment Officer and Founder, Case Capital Advisors, Kenny Polcari, and Yahoo Finance Senior Reporter Brooke DePalma. Kenny, good to see you. Lots to get to, but really, now that I've had the time to digest what the president said yesterday at Davos, what he said about the stock market potentially doubling this year, I can't say that I didn't expect it, but is it even in the realm of possibilities this year?
Well, doubling, probably not, right? Are there certain stocks that'll double? Probably yes. But, that's part of his narrative, right? It supports his story about, how great the economy is doing and how great America is and all that stuff. And I get it. But, just throwing out comments like that is, honestly, it's noise. It's useless. It doesn't really do anything.
Ben, how about you? From an interest rate perspective, is the grounds, if we're not going to get a double on the market this year, is the interest rate backdrop at a place that would support another year of double-digit gains?
Well, I think, Brian, if you get double the stock market, it really will reflect the economy doubling, right? Because the GDP data that came out this morning, again, was a little bit stronger. And this is backward-looking data now. This is third quarter, right? So we're shaping up for a good fourth quarter, I think, into the first quarter. So doubling the stock market, from my perspective, would mean if you're getting higher GDP, say 5% or higher, then interest rates are going to reflect that, and it's likely going to be a little bit higher. So the 10-year yield has broken out now above 420, and just irrespective of the Greenland noise that was happening, it is, I think, reflecting the stock market and the GDP expanding here. So I think from an interest rate perspective, the Fed may stay on hold for a bit, and the 10-year could go up in yield.
Kenny, if we acquire Greenland, that should double the economy, right?
Might double the economy. I'm not sure. There's 50,000 people that live in Greenland, right? While it's all very exciting, and I get it, and I think he made a great argument on why it's necessary. And quite honestly, I think the Europeans in Denmark, recognize that his arguments are not wrong. But what I see there is opportunity, right? There'll be opportunity in infrastructure names. There'll be opportunity in aerospace and defense names. There'll be opportunity in, technology names. So I think it's all very bullish. But again, that speaks to a strong economy and a strong market, but by no means a doubling. You're talking about the S&P going to 14,000. I don't think that's
we got to ask some tough questions here, Kenny. Brooke, while we're having this conversation, the stock market potentially doubling, Goldman Sachs raising their outlook on gold. So that doesn't necessarily align.
Yeah, well, Goldman Sachs predicting a 17% upside for year-end 2026 when it comes to gold. They now expect it to hit about 5,400. That's the year-end target that they're putting out. But it sort of does have to go in line because of this geopolitical uncertainty. We've seen this before. We've seen investors turn to gold as a safe haven, and they really do expect that to continue. Goldman Sachs specifically saying within this note out this morning that, one, risks are skewed upside. That's the note at the end. They said that private sector investors may diversify diversify further on lingering geopolitical uncertainty. In addition to that, they also said that central bank buying is expected to average around 60 tons a month this year alone. And they also went on to say that they expect a further 50 basis point easing from the Federal Reserve. And so all these sort of factors playing into gold. Keep in mind, gold futures up about 10% this month, but silver has actually had an even larger return year to date.
Brooke, what do you think about President's comments on the stock market potentially doubling?
I mean, definitely got a lot of attention across X. People were sort of taking that and picking it out and putting it in a post alone. And I think it just really goes to show that obviously very bullish about the returns that we could see, sort of pointing out what we saw during his last term as president. And also keep in mind, it simply goes to show that the taco trade definitely still exists. The stock market rallying at 2:30 yesterday afternoon was certainly a sight to see. And it just goes to show that investors are somewhat distracted by this noise, but largely looking at the fundamentals of AI, which I know we'll talk a lot more about.
Kenny, how should one go about playing that taco trade?
Well, so listen, I think you have to separate the noise from the fundamentals, right? And I've been saying that in my note over the last couple of days. Everything that we saw this week, Tuesday, Wednesday, was all about the noise. It was about NATO, Denmark, Greenland, had nothing to do with earnings, the Fed, interest rates, earnings, nothing to do with it. Right now, we've gotten through that. The noise is kind of behind us, and people are going to start to focus once again on the fundamentals. So I think it's going to be, we're going to look at earnings. We're getting 6 or 7 of them due today. We're going to start to get a broadening out of who's reporting, right? We've got airplane parts. We've got base metals outcome. We've got airlines coming out. We've got some technology, more banks coming out. So we're going to start to see a broader view of what the economy looks like. That being said, I think you have to stick with what's working. I don't think the AI trade is in a bubble, nor do I think it's going away. And if you paid any attention to the conversations going on at the World Economic Forums around technology, there are massive demands coming out. CEOs are still talking about spending massive amounts of money as they start to incorporate this AI. So I think that's still very much a trade. Names like Microsoft, Amazon, Apple, Google are all going to be consistent names that people should have as part of their core portfolios this year.
Ben, if you're reading, if you've been watching the president's comments, let's say the past week or so, it sure seems like Kevin Hassett's not going to get this Fed job. Seems to like Hassett, what he's doing right now, going on TV, talking bullishly on the economy. If it's a Kevin Warsh, or even, let's say, even a Rick Reeder, friend of the show, we've known Rick for a long time. Would it be more, I guess, just less bullish for stocks? Because the thinking was Hassett would get this job. He at one point was somewhat of a shoo-in, and that would be bullish for stocks on the view that he might be more inclined to cut rates.
I think that's right, Brian, because, who's going to be the best friend of the markets here from the remaining candidates? Rick Reeder clearly is, I think, because of his background and being a portfolio manager himself and having spoken in interviews with yourself and other networks that he really sees his balance sheet as an opportunity to help the housing market and thereby, stimulate essentially the economy, which the stock market will pick up as positively. Kevin Warsh has a very different view about that. He says, no, we have to focus on interest rates with the Fed, and this balance sheet cannot play a role, and fiscal spending actually has to be reined in. And although there's some views within the administration about that too, at the end of the day, I think it's about who's really going to drive this administration message out there through the Fed. That seems to be more like a Rick Reeder being more bullish for the markets, whereas you say Kevin Warsh has a more hawkish tone. So I think the market will react negatively if the announcement is that Kevin Warsh will be the next Fed chair.
Shout out to Rick Reeder, of course, apparently in that running. Ben, let me stay with you here. The economy printed in the third quarter, almost 4.5% GDP growth. Yet I have a conversation with P&G's CFO. We're going to air it on the other side of this break, talking to me about how the consumer is dosing how much they use in terms of Tide and various other detergents. Like, where is the disconnect here, Ben?
Yeah, I think it's still about how quickly is this investment picking up in the economy? There's some tentative signs of seeing now the spending from AI converting into actual investment. Take the example of SoftBank or take the example of TSMC. But then we also have the spending in itself, which people have noted, there's just the upper end that's spending robustly, but the lower end is not. And we have an inflation issue that's still not properly dealt with enough, at least, to give more relief to that segment of the economy. So these affordability issues become political, but it's also an economic issue. So I think the GDP numbers reflect sort of a combo of investment and spending. I think it will accelerate actually from here, but it's really that if the lower end of the low segment of the economy, low income, really get a relief, one direction or the other, I do think this economy will pick up really significantly.
Brooke, P&G's results, I mean, not exactly great, weren't horrible. They retained their outlook, but I didn't like some of the commentary, like I just mentioned, on where the consumer is. Then you look at McCormick out this morning. I guess people, if they're strapped for money, they're just eating borderline rancid meat and paying up for spices to make it taste good. What's up? What else can you take away from something like this?
Brian, I think this just goes to reiterate exactly what we saw in 2025. People are picking and choosing where they want to spend money, and they're only splurging if they feel like it is 100% worth it. And these consumer-facing companies really at the forefront of sort of that aisle where you think twice. Do I need that bigger size of detergent? Do I need that extra spice in my spice rack, or can I just make do with what I have? It's this choiceful consumer that continues to make way into 2026, and that's reflected in these fourth quarter results.
Kenny, I'm gonna get a lot of crap for this one, but I figured you would appreciate. You know what a lot of these spice companies have done? They've made the holes larger on the top of the, so you use more. So you go out and buy more, and this stuff's expensive. Kenny, you're a cook. You know the deal.
Yeah, and I actually think, I hate to tell you, I actually think the container's just a little bit smaller. So the holes are bigger and the container's smaller. And so therefore, it's like shrinkflation, right? And so, yes, it does become an issue. So I think people get to be a little bit more careful on how they cook, how much they're cooking, and they're very aware of it. Because to your point, it is expensive. Spices are expensive for people, so they need to be cautious, I guess, on how they're using them, and I think they will become more cautious on how they use them.
Lastly, Kenny, do you need to stay cautious on consumer staples? You know, I think back to, let's say, a decade ago, everybody loved a lot of these stocks. Oh, they pay dividends, they're steady, and I still hear that thinking now, but it's totally wrong. Sure, they may pay a dividend, but the earnings growth and the sales growth, it sucks, and it's still continuing to get worse.
So listen, consumer staples, I think, were one of the underperformers last year. It wasn't the worst. I think it was the second worst performer. But look, I like consumer staples. It has a position, a percentage position in the total portfolio because it should, right? It should offer some stability. They may not be the NVIDIAs and the Apples and the Googles, and they're not going to grow at 150% a year, but they offer stability to an investor, to a portfolio, especially if you're a little bit nervous. Look, we're in a midterm election year. Typically, the market, we're going to see a 15 and 19% pullback in the market at some point this year. I think it's going to happen in the first 6 months or so. And in that case, you want some names that are boring, but yet that will offer stability. So I'm all in on consumer staples. Not overweight, but I think you have to have them as part of your portfolio.
And in case anyone's wondering, my favorite spice, it's just salt. Love to put it on my steak. Just love me some salt. Bring it on. Big thanks to my opening bid roundtable. Great to see you all. Thanks for bearing with me and my absolute ridiculousness. Inside the world of Tide Pods and Gillette razors on P&G earnings day, my combo with CFO Andre Schulten, I should say, next. Consumer products giant Procter & Gamble is out with better than expected results. Guidance more in focus, though, as consumers in the U.S. battle through affordability challenges down the supermarket shopping aisles. I caught up with P&G CFO Andre Schulten on all this.
I would characterize quarter two as a quarter that sets us up for growth in the second half of the year. Why do I say that? The business outside of the U.S. Is growing 3%, so growing actually very well. We have Latin America growing at 8%, China growing at 3%, Europe in aggregate growing at 3%. Our Asia, Middle East, Africa region is growing at 2%. So you see the growth outside of the US is consistent and broad-based with all of the innovation, all of the interventions on the commercial side, all of the interventions on the go-to-market side that we started about 12 months ago are taking hold and delivering as we expected. The US is a bit unique in the quarter that we just completed. We had a significant inventory build in the base year. So about a year ago, we had 2 port strikes and a hurricane in the US, which led retailers to build significant inventory, specifically on our household care business, and consumers built pantry inventory. So those led to a weaker shipment quarter in the US and in aggregate to the result that you see for the quarter. The exciting part is the innovation plans and the commercial plans that we have started to execute in the US and that we are executing across half two have the same characteristics as the plans that have led to growth outside of the US. So we're very confident that they will also lead to an inflection on the US business. And again, if you take the base effect of the inventory loading out of the quarter, we would already have seen growth. So this is now a matter of time to emerge in the second half. There are always things that can negatively affect the business. So we keep our guidance range, both on the top line and the bottom line. But we're confident that we're on the right path.
Andre, within your outlook for the year, again, reaffirm that those top and bottom line outlooks. How important is it that the U.S. starts to turn the corner, that U.S. shopper that has been worried about affordability when they go to the grocery stores, how important is that consumer to you delivering on your outlook?
I would say that the underlying consumption that we see of P&G categories has to sustain. If you take out the pantry loading, over the last 3 months, the P&G consumption would have been about 1.5% to 2% in terms of value. So at a minimum, we expect that consumption to sustain. If we are successful in the execution of our commercial plans and all the innovation we're launching in the second half in the US, we feel pretty good that we're going to be able to do that and hopefully a little bit better. So that's an important part of the guidance range. The other part of the guidance range is that we obviously want to sustain the momentum that we have created outside of the US. But the range we have communicated at the beginning of the year is fairly wide, given the volatility and given all the unknowns that we see around the global business. But the US is important, not a material step change in terms of underlying consumption, but sustained momentum outside of the US. Both components would lead to a good outcome for the fiscal.
Consumer products companies have been taking some heat recently, Andre, on just continuing to shrink the sizes of what they sell and raise the prices. What do you say to that?
I say the categories we are in are daily use categories, and performance is very important to the consumer. If you do your laundry, you want your laundry to come out clean and smell nice the first time. If you use a diaper, you want the diaper to work overnight and not cause every skin irritation. So the products we sell are used frequently, and the performance of the product is very important to the consumer. And the consumer is a very diligent judge of value. And value in our categories really is defined as the product performance, the packaging execution, how well we communicate the performance, and how we execute that in store and online, relative to the price that we're asking the consumer to pay. If that balance is right, we see the consumer choose P&G brands, and we see the consumer even trading up within the P&G portfolio because they like the promise we make on better performance, they trust the brands, and they trade up to a high order proposition. The other element I would tell you is critically important for us to offer the consumer choice. So we offer choices in terms of different tiers. If you want the super premium diaper, we have Swaddlers. If you want the mid-tier diaper, we have Baby Dry. If you want a value diaper that is closer to private label pricing, we have Loves. And we need to be competitive versus the next best competitive offer in all of those in terms of value. And again, performance relevant for the consumer relative to the price we pay. So my simple answer is I think the consumer is a diligent judge of value. So it's our job to keep that equation in equilibrium. That's why we start every conversation with the consumer at the center. Are we delivering truly irresistible superiority relevant for the consumer? And value is a part of that superiority.
Andre, I don't know if you're following the World Economic Forum in Davos. We're getting a lot of interesting headlines on the state of the U.S. economy. President Trump saying that he thinks the economy is growing 4 to 5%, can continue at that growth rate. NVIDIA's CEO Jensen Huang saying 6-figure jobs are being created from AI data centers. When you study the U.S. consumer and the health of that shopper, is the consumer as strong right now as some of those numbers or some of those headlines would suggest?
Well, those headlines are certainly exciting. What we're seeing and observing is growth in our categories in the US and outside of the US, albeit at a slower pace. So if you look at our categories, they have grown in the past 3 months in the US somewhere between 1% and 2% in terms of value growth. more flattish in terms of volume growth, which is about consistent with what we're seeing in Europe, and is slower than what I would characterize as the typical growth rate that we see in our categories, which is more in the range of 3 to 4%. Part of that is base period, but part of that is just slower consumption, and the consumer is choosing to be a little bit more diligent in terms of using up pantry inventory, maybe dosing the product a little bit more carefully, maybe making choices in terms of how frequently they use. None of this is untypical. None of this will sustain. So we firmly believe the category over time will return to 3 to 4% growth. And we view it as our job, Brian, to help lead that turnaround in terms of category growth acceleration, because in many of these categories, we are the market leader. So bringing in new innovation, bringing in excitement to the category, bringing in better performing products, better communicated promises of performance, all of that is our way to initiate category growth. So not strongly growing, more 1 to 2% now, but our job is to return it to 3 to 4%, and typically that would happen over time.
You're also maintaining your expectation on how much tariffs will impact the business this year, about $400 million. And I think you offer an interesting perspective on this, given where you spent a lot of your career. A lot of focus now between renewed geopolitical tensions between the U.S. and Europe. Have you crunched the numbers on what fresh tariffs on Europe would mean to a business like P&G, and how much of a hit would it be?
Yeah, our tariff exposure came down from the beginning of the year, where it was about $1 billion, to about $400 million after tax now. The P&G team has done I think, fantastic job in dealing with those tariff exposures via strong productivity work, sourcing changes, formulation changes where necessary and possible. And then the remaining exposure was offset with innovation-based pricing, which we typically do every year. We treat tariffs like we treat commodity or foreign exchange rate. We tend not to speculate and run the numbers before we have the facts. So I really don't have a good answer for you. I apologize. But in any case, wherever foreign exchange rate goes, wherever commodities go, wherever tariffs will go, it'll be the playbook for us, the same playbook for us, Brian. Productivity, sourcing formulation changes where possible, innovation and pricing, that's the combination. And to our earlier conversation, carefully respecting consumer value in the process.
Fun fact on P&G, good work by the research team at Evercore ISI tracking patent activity by P&G. They recently stumbled upon this one for a new razor being dubbed Lystra, or Lystra, I guess. You see the components of the razor on your screen. By the looks of the drawing, the razor will connect with your smartphone to track when you need to change your blades. P&G makes absolute bank off razor blade refills, so I am not surprised to see it working on a gadget that could tell me it's time to go out and spend a lot more money on blades. I get it. Julie Hyman has you on the other side of the break. Market Catalyst.